Hello, it's Lon Welsh at Your Castle Real Estate, and I want to talk a little bit about how the real estate market is changing in a really unusual way after COVID. And what we saw from employment, and there's a great chart here from the Wall Street Journal, is that the people who lost their jobs and had the most economic distress in this downturn tended to be younger, less income, and lower education. And those three things tend to go together. And the people who have done the best through this have been the people who tended to be somewhat older, more educated, and high income. And this chart really illustrates that. You can see that the payroll for the high wage people only dropped a tiny amount through the whole COVID crisis versus the people in the entry level jobs had the most dramatic drops. Given that, I'm going to show you a slide or two of what's going on in the high-end market, because I think you're not going to be surprised by the outcome that this has had. The other important driver for the high-end market is that when the stock market is doing well, there's what's called a wealth effect by economists, that people feel more comfortable in spending some of their money. And when the stock market isn't doing well, especially on the high end, they tend to be a little bit more conservative about spending. So in March, we saw that the US stock markets dropped almost 25%, and that really put a dampening mood, along with all the other negative publicity about COVID, on buying anything, let alone trading up to a luxury house. But since then, the stock market has completely recovered, and the people in the high-end jobs who tend to be able to afford luxury homes haven't had much for income changes at all. So that confidence, the confidence of the stock market and the fact that we've got extremely low interest rates, has fueled a little bit of a boom on the high-end market, which I did not honestly expect to see something this ferocious for a recovery on the high end if you would have asked me back in March. So if you take a look on the right-hand side of this slide, you're going to see the number of newly added listings for the luxury market in Denver, over 900,000. And you can see during COVID, we had about 200 fewer listings than you would historically anticipate. But since the showing restrictions have been lifted, you can see that we've had 450 more listings than historical. So not only have we backfilled the lost time from COVID, we've added an extra large number of 200 luxury homes, which is a lot in addition to that. So there's quite a lot of supply out there for a prospective buyer to take a look at. So are they looking? And the answer is, on the left-hand side, yes, they're pretty excited about looking at the houses. This is the ones that went under contract. So no particular surprise, during the height of COVID in March and April and the first part of May, we had about 200 fewer contracts than you'd expect. But since the showing restrictions have been lifted, we've had 550 more contracts than you'd anticipate. So a real surge in buyer interest, partially fueled by the low interest rates on the jumbo loans and the confidence inspired by the stock market. So what's it mean for closings? During COVID, we missed about 320 closings, and so far we've made up 130. But given the extremely strong showing traffic on the high end, the very large number of under contracts, the very healthy number of people applying for jumbo mortgages, I'm pretty confident in August and September we're going to greatly outperform in the luxury segment from what we did last year and the year prior. Maybe not enough to make up for the entire deficit from COVID, but we'll probably narrow almost all of the gap.